Money Power Fraud presents the Madoff Masterclass, Reverse Engineering Split Strike Loops. Chapter 1. The Illusion of Consistency, Manufacturing Stability in Chaos. The defining feature of Bernard Madoff's operation was not deception, it was consistency. Markets are volatile by design, returns oscillate, correlations break, liquidity tightens, capital cycles compress and expand. Institutional allocators understand this. They price risk into portfolios because variance is inseparable from return. Madoff offered something structurally unnatural: smoothness. Month after month, his reported performance hovered within a narrow band. Modest gains, minimal drawdowns, no violent swings during turbulence, no dramatic spikes during rallies, just steady compounding. To sophisticated capital, this did not look greedy. It looked disciplined. That is the masterstroke. High returns invite scrutiny. Extraordinary returns trigger competitive analysis. But consistent mid-range returns create psychological sedation. They appear prudent, hedged, conservative, institutional. Consistency became the product. The narrative attached to that product was equally calibrated. The so-called split strike conversion strategy was positioned as a volatility management system. Blue chip equities for stability, covered calls for income, protective puts for downside insurance. The structure implied mathematical restraint. It sounded like risk mitigation. It felt like engineering. In a market conditioned by crashes, 1987, the dot-com volatility cycle, early 2000s instability, investors were not searching for brilliance. They were searching for insulation. Madoff did not promise outperformance. He promised emotional equilibrium. That is the deeper architecture of the fraud. Predictability as bait. Capital allocators face internal pressures. Pension managers answer to boards. Wealth managers answer to clients. Fund of funds managers answer to institutional committees. Volatility threatens reputations. Drawdowns threaten mandates. Consistency protects careers. A smooth 1% monthly gain reduces oversight. It reduces questioning. It lowers compliance friction. It quiets committees. It becomes career-safe capital. The illusion of consistency exploited three cognitive vulnerabilities. First, volatility aversion bias. Investors disproportionately fear losses relative to equivalent gains. A strategy that appears to suppress drawdowns activates relief more than excitement. Second, narrative coherence bias. When a strategy's explanation aligns with its outcome, hedging strategy, low volatility returns, skepticism declines. The story matches the numbers. Third, authority anchoring. Because Madoff's reputation signaled market sophistication, investors interpreted smooth returns as evidence of proprietary execution capability, not fabrication. Consistency, therefore, was not just numerical manipulation. It was behavioral manipulation. What makes this masterclass instructive is not the fabrication itself. It is the targeting precision. Madoff did not chase unsophisticated retail capital at scale. He cultivated institutions and high-net-worth networks that valued steadiness over spectacle. He understood that professional investors measure risk not only in percentage terms, but in optics. A portfolio that loses 25% during a downturn invites investigation. A portfolio that gains 0.8% during the same downturn invites admiration. During periods when markets whipsawed, his statements showed calm assent. That calm signaled insulation from systemic stress. The very chaos that heightened anxiety in the broader market amplified his appeal. The illusion strengthened under volatility. Every month of smooth performance reinforced three internal conclusions among investors. The strategy works. The manager is disciplined. Access must be protected. This reinforcement loop converted performance statements into marketing collateral. Each confirmation report functioned as psychological evidence. Critically, the fraud relied on statistical plausibility, not statistical extremity. Returns were engineered to sit just below disbelief thresholds. That restraint extended the lifespan of the scheme. Had he posted 25% annually, the system would have collapsed faster. By offering 10 to 12%, he blended into the upper range of hedge fund performance without triggering envy-driven replication. In effect, Madoff weaponized moderation. The lesson for capital markets is structural. Abnormal smoothness is as suspicious as abnormal spikes. True strategies that deploy options overlays, particularly during periods of elevated implied volatility, produce dispersion. Hedging costs fluctuate. Assignment risk exists. Slippage occurs. Liquidity constraints emerge. A strategy claiming continuous stability across regimes is not conservative. It is statistically improbable. The split strike narrative framed risk suppression as expertise. But real markets charge premiums for protection. When someone claims protection without performance drag, they are either subsidized, lucky, or fraudulent. This chapter establishes the foundation of the Masterclass. The fraud did not begin with forged documents. It began with an engineered emotional state. Confidence without excitement, safety without scrutiny, performance without variance. Consistency became camouflage. Understanding this psychological architecture is essential because modern financial ecosystems continue to reward smooth return profiles. Private credit funds, structured products, volatility selling strategies, and AI-driven trading systems all market stability. When capital prioritizes emotional comfort over structural transparency, the illusion of consistency will always find demand. The first phase of the split strike loop was not capital, it was trust manufactured through statistical sedation. That is the real masterclass. Chapter 2. Phase 1. Capital aggregation through institutional credibility. The first operational layer of the Madoff system was not performance fabrication. It was authority construction. Before the fraud scaled, Bernard Madoff positioned himself inside the financial establishment. He was not an outsider challenging the system. He was embedded within it. Former chairman of NASDAQ, market structure participant, respected broker-dealer operator. This institutional proximity functioned as pre-installed due diligence. Professional allocators rely on signaling hierarchies. Credentials, board memberships, exchange leadership roles. These are interpreted as competence filters. When an operator sits inside market infrastructure, skepticism decreases because the perceived probability of oversight increases. That perception was false. The aggregation phase relied on 4 reinforcing credibility loops. First, status anchoring. Association with exchange leadership created a halo effect. Investors assumed regulatory familiarity implied regulatory compliance. They conflated structural access with structural integrity. Second, exclusivity engineering. Access to the strategy was framed as limited. Investors were told capacity constraints existed. Allocations were selectively granted. Scarcity increases perceived value. More importantly, it suppresses interrogation. When access feels fragile, beneficiaries avoid behavior that might jeopardize it. Third, affinity network amplification. Madoff leveraged tight social circles, country clubs, philanthropic networks, elite wealth communities. Trust transmitted laterally. If a peer allocates, that allocation becomes an implicit endorsement. Due diligence became outsourced to social proof. Fourth, gatekeeper shielding. Feeder funds acted as capital consolidators. Rather than thousands of direct investors performing analysis, a smaller number of fund managers aggregated assets and performed surface-level vetting. This created institutional insulation. Responsibility fragmented across intermediaries. When responsibility fragments, accountability diffuses. The aggregation architecture solved a critical problem for any Ponzi structure: inflow stability. Instead of chasing retail flows vulnerable to sentiment swings, Madoff cultivated capital pools characterized by longer lockups, committee-based decision cycles, reputational reluctance to admit error, professional deference to pedigree. Institutional investors are often slower to exit because exit implies failure of their internal review processes. That inertia extended the life cycle of the scheme. Credibility also altered the psychological burden of proof. When an unknown manager presents extraordinary stability, scrutiny intensifies. When a market insider presents moderate stability, scrutiny relaxes. This is inversion of skepticism. The existence of Bernard Madoff Investment Securities LLC as a long-standing broker-dealer further reinforced the legitimacy illusion. The firm executed real trades for market participants in its market-making capacity. That legitimate activity created operational noise: phones ringing, terminals active, employees visible, which visually resembled authentic investment management infrastructure. Optics substituted for verification. Capital aggregation also benefited from layered narrative control. Investors were told the strategy was complex, that it relied on proprietary timing, that capacity was finite. Complexity discourages replication attempts. Scarcity discourages confrontation. The more capital that entered, the stronger the perceived validation became. Growth itself signaled credibility. This is the reflexive component of fraud scaling. Inflow validates reputation. Reputation attracts inflow. At no point in this phase was dramatic performance necessary. The engine required only enough consistency to sustain belief, while institutional endorsement expanded the capital base. The lesson is structural. Fraud at scale does not begin with spreadsheets. It begins with network positioning. Institutional architecture can be repurposed as camouflage. When credibility precedes verification, capital aggregates faster than skepticism. Phase 1 of the split strike loop was therefore not financial engineering. It was trust engineering. Capital followed status. Status replaced scrutiny. Aggregation became self-reinforcing. That is how the foundation was laid. Chapter 3, Phase 2. The split strike conversion narrative. The core of the operation was not the fraud itself. It was the explanation of the fraud. Madoff did not claim to be a genius stock picker. He claimed to run a disciplined options overlay strategy known as a split strike conversion. The brilliance was in selecting a strategy that sounded both sophisticated and conservative. The stated structure was straightforward on the surface. Purchase a basket of large cap equities, typically components of the S&P 100. Sell out of the money call options against those positions to generate income. Purchase protective put options to cap downside risk. Equity exposure for participation. Covered calls for yield enhancement. Protective puts for insurance. To an allocator, this reads like institutional prudence. The terminology itself creates distance. Option collars, strike spreads, delta exposure, hedged equity overlays. These terms reduce accessibility. When complexity increases, replication attempts decline. Investors assume proprietary execution capability. The strategy narrative achieved 3 objectives simultaneously. First, it justified steady returns. Covered call strategies generate premium income. That income can smooth performance in sideways markets. Investors could rationalize consistent gains as premium capture combined with hedged exposure. Second, it explained limited volatility. Protective puts theoretically cap downside. When markets decline sharply, hedged portfolios fall less. The story matched the reported outcome: resilience during turbulence. Third, it discouraged benchmarking. Because the strategy was described as dynamically hedged, investors could not easily compare it to the S&P 500. Underperformance in bull markets was excused as the cost of protection. Outperformance in bear markets was framed as risk discipline. The narrative neutralized comparison risk. But the mathematics did not support the consistency. A genuine split-strike strategy faces structural frictions. Option premiums fluctuate with implied volatility. Execution costs reduce net yield. Hedging drag limits upside. Market gaps create slippage. Liquidity constraints affect strike availability. These variables introduce dispersion. Returns should vary meaningfully across volatility regimes. Madoff's reported returns did not. They remained within a narrow performance band, regardless of whether volatility spiked, markets rallied sharply, or option premiums compressed. The absence of volatility clustering was statistically anomalous. Even more critically, market volume data contradicted the scale implied by his reported positions. The number of options contracts required to hedge billions in equity exposure would have left visible footprints in exchange data. Those footprints were not present. The operational claim exceeded observable market activity. This is where the masterclass becomes technical. Fraud endurance depends on plausibility density. The split-strike strategy was plausible enough to deter casual scrutiny, yet opaque enough to prevent independent verification by most investors. Very few allocators possess deep derivatives execution expertise. Fewer still will independently audit exchange volume against reported exposure. The complexity created a protective moat. Additionally, the strategy description exploited a cultural truth within capital markets. Many institutions believe edge exists in execution timing. If a manager claims to enter option positions at optimal volatility windows, investors may attribute smooth performance to proprietary market access rather than fabrication. Skill attribution replaced forensic validation. The narrative also benefited from moderation. Returns averaged in the low double digits. Too high would have triggered disbelief. Too low would have reduced attractiveness. The band was engineered to sit inside the elite but believable range. This is critical. Fraud that mimics hedge fund dispersion invites audit. Fraud that mimics disciplined income strategies invites patience. The split-strike explanation functioned as a structural anesthetic. It dampened skepticism by aligning language with desired emotional outcomes. Prudence, discipline, protection. Underneath that narrative, there were no trades. The equity purchases did not occur. The calls were not written. The puts were not bought. Statements were manufactured to reflect hypothetical trades priced retrospectively for smoothness. This was not aggressive risk-taking hidden from investors. It was zero risk-taking disguised as calculated hedging. The genius of the phase was selection of a strategy that few would deeply interrogate, yet many would intellectually respect. The lesson for modern markets is direct. When a strategy relies heavily on derivative complexity, verification must extend beyond performance statements. It requires trade confirmation cross-checking, counterparty validation, exchange volume reconciliation, independent custodial reporting. If the explanation for stability depends on sophisticated hedging, the hedging must be externally observable. The split-strike narrative was the intellectual armor of the fraud. It provided just enough structural detail to quiet inquiry without offering verifiable transparency. Phase 2 succeeded because the story of the strategy felt more sophisticated than the skepticism of the investor. That imbalance sustained the illusion. Chapter 4. Phase 3. The obfuscation layer. Every durable fraud requires insulation. Once capital aggregated and the split-strike narrative established intellectual cover, The next requirement was structural opacity. The system needed to prevent independent verification while preserving the appearance of institutional infrastructure. The mechanism was vertical integration. Bernard L. Madoff Investment Securities, LLC, functioned simultaneously as investment advisor, broker-dealer, trade executor, custodian, record keeper. In legitimate asset management structures, these roles are separated. An independent custodian holds assets. A prime broker clears trades. A third-party administrator reconciles performance. An external auditor verifies financial statements. Separation creates friction. Friction creates transparency. Madoff collapsed these functions into a single node. When the same entity claims to execute trades, hold assets, and report performance, verification becomes internal. Investors receive confirmations generated by the manager. Statements appear official. Trade tickets appear detailed, but there is no external reconciliation layer. This is structural self-certification. The obfuscation layer relied on document sophistication. Trade confirmations were backdated to align with optimal pricing. Monthly statements reflected hypothetical transactions selected to maintain return smoothness. Positions were fabricated to match the split strike narrative. Importantly, the documents were not amateurish. They mirrored the formatting and language of legitimate brokerage confirmations. To a non-derivatives specialist, they appeared authentic. Complexity protected forgery. Another critical insulation vector was auditor selection. The auditing firm associated with the operation was small, obscure, and operationally incapable of meaningfully reviewing a multi-billion-dollar derivatives strategy. That mismatch alone was a red flag, but credibility bias suppressed alarm. Investors often assume that if an auditor exists, scrutiny exists. In reality, audit scope depends on access, competence, and independence. In this case, the audit function operated without the depth required to detect fabrication. The absence of independent clearing data was another structural vulnerability. Large derivatives positions leave footprints across counterparties. Clearinghouses record volume. Prime brokers maintain exposure data. None of that external footprint aligned with the scale reported. Yet most investors never demanded counterparty confirmation. The obfuscation layer also leveraged operational theater. The brokerage side of the business engaged in legitimate market-making activity. There were employees, trading terminals, communications infrastructure. Visitors observed activity consistent with a functioning financial enterprise. Visual authenticity reduced investigative urgency. Fraud at scale often depends on blending real and fabricated operations. The legitimate broker-dealer activity created noise that masked the advisory fraud. Observers saw infrastructure and inferred systemic integrity. But the structural flaw remained singular and fatal: no independent custody. If assets are not independently held, statements are narratives, not evidence. The system's durability also depended on controlled information flow. Performance reporting was centralized. Data transparency was minimal. Strategy details were described conceptually, but not operationally. Investors did not receive granular execution timestamps tied to verifiable exchange data. Opacity was framed as proprietary protection. That framing is a recurring pattern in modern financial fraud. Claims of intellectual property, algorithmic secrecy, or strategic confidentiality are used to justify limited transparency. The more sophisticated the claimed strategy, the easier it becomes to resist disclosure under the banner of competitive protection. The obfuscation layer was not about hiding numbers. It was about eliminating verification pathways. No third-party custodian, no independent administrator, no meaningful audit depth, no counterparty reconciliation. Without those structural checks, performance becomes whatever the manager declares. The endurance of the scheme demonstrates a critical institutional lesson. Governance failure often stems from assumed safeguards Rather than verified safeguards, investors assumed someone else had checked. Feeder funds assumed the auditor had validated. Regulators assumed the size implied oversight. Assumptions compounded into systemic blindness. Phase 3 completed the defensive architecture of the split strike loop. Capital entered under the protection of credibility. Performance was justified through technical narrative. Verification was neutralized through structural consolidation. From this point forward, the system required only one input to survive: continuous inflow. Once inflow slowed, the insulation would crack. The obfuscation layer did not make the fraud profitable. It made it sustainable. Chapter 5: The Feeder Fund Amplification Engine. The Madoff structure did not scale because of individual investors. It scaled because of intermediaries. Feeder funds were the force multiplier. These were independent investment vehicles that raised capital from clients and allocated large blocks into Madoff's operation. Rather than thousands of investors conducting parallel diligence, capital flowed through concentrated gatekeepers. This changed the risk dynamic entirely. Instead of direct scrutiny from each allocator, Madoff needed to maintain confidence among a relatively small network of fund managers. Those managers, in turn, reassured their own investors. Responsibility fragmented. The architecture looked like this: investor to feeder fund to Madoff, client to gatekeeper to central node. With each layer, perceived due diligence increased. In reality, scrutiny diluted. Many feeder funds marketed their access to Madoff as a competitive advantage. They presented themselves as having privileged entry into an exclusive strategy. That exclusivity narrative enhanced their own value proposition. Access became a product. This created a powerful incentive distortion. If a feeder fund derived performance and fees from allocating to Madoff, challenging the legitimacy of the strategy threatened its own revenue model. The manager's livelihood was partially dependent on the continuation of the reported returns. Incentive blindness replaced skepticism. The amplification engine operated on 3 reinforcing mechanics. First, reputation laundering. A feeder fund with an established brand allocated to Madoff. That allocation functioned as endorsement. Other investors interpreted that decision as evidence of robust due diligence. Second, due diligence substitution. End investors assumed the feeder fund had deeply vetted the strategy. The feeder fund assumed the auditor and regulatory status implied legitimacy. Each layer deferred verification to another. Third, scale efficiency. Instead of onboarding capital investor by investor, Madoff could absorb hundreds of millions at once through a single intermediary relationship. This accelerated growth without proportional scrutiny. The system's resilience depended on network density. The more interconnected the participants, the harder it became for dissent to spread. Investors were embedded in overlapping social and professional circles. Questioning the strategy risked social friction. Affinity amplified inertia. When warnings surfaced from external analysts questioning performance plausibility, those warnings struggled to penetrate the network. Internal stakeholders had reputational exposure. Admitting potential fraud meant admitting diligence failure. Professional pride became defensive armor. Another structural factor was opacity within the feeder funds themselves. Many did not provide granular transparency to their own investors about position-level exposure. Allocations were reported in aggregate. That reduced visibility into concentration risk. Some feeder funds allocated an overwhelming majority of assets to Madoff, despite marketing diversification narratives. Concentration risk hid behind structural abstraction. The amplification effect was exponential. Each new feeder fund increased total inflow, expanded the network of implicit endorsements, reinforced the perception of institutional validation. The more capital aggregated, the more improbable fraud appeared. Investors often equate size with safety. Large-scale operations are assumed to attract oversight. In reality, scale can create intimidation. If billions are already invested, individuals hesitate to assume they see something others missed. This is herd reinforcement at institutional scale. The feeder fund engine also prolonged collapse. Because capital was pooled, redemption decisions were mediated by fund managers. Withdrawals required internal processes. That delay smoothed liquidity pressure during early stress periods. But when redemption requests accelerated during the 2008 financial crisis, the same concentration that enabled rapid growth created rapid strain. Large capital blocks sought withdrawals simultaneously. The amplification engine reversed polarity. What once magnified inflows now magnified outflows. The lesson is structural and contemporary. Intermediaries increase complexity. Complexity reduces direct accountability. When capital allocates through layered structures, verification must increase proportionally, not decrease. Feeder funds were not incidental participants. They were structural accelerants. Without them, the fraud remains localized. With them, it becomes systemic. Chapter 5 demonstrates that large-scale financial deception rarely operates alone. It requires distribution channels. Trust was not only engineered at the top, it was syndicated. Chapter 6, regulatory blind spots and structural deference. Large-scale financial fraud does not survive solely on deception. It survives on institutional hesitation. In the Madoff case, repeated warnings were submitted to the U.S. Securities and Exchange Commission detailing the mathematical impossibility of the reported returns. The most notable came from derivatives analyst Harry Markopoulos, who presented structured analyses outlining volume inconsistencies and statistical improbabilities. The data was there. The failure was structural. Regulatory bodies operate under resource constraints, political pressures, and reputational risk calculations. Investigating a prominent market figure carries institutional cost. If the allegation proves unfounded, the regulator risks reputational damage. If ignored and correct, the damage is delayed. Bureaucracies tend to avoid immediate embarrassment over future catastrophe. This is reputational asymmetry. The Madoff operation exploited 3 regulatory vulnerabilities. First, technical complexity gaps. Derivatives strategies require specialized expertise. Not all enforcement staff possess deep options market knowledge. When confronted with complex hedging narratives, regulators may defer to the manager's explanation rather than independently reconstruct the trade logic. Second, institutional deference. Prominent market participants benefit from credibility bias. A former exchange chairman does not present as a likely architect of systemic fraud. Authority distorts investigative urgency. Third, fragmented oversight. Broker-dealer activities and advisory activities often fall under different review scopes. When business lines are compartmentalized, cross-functional anomalies may go undetected. Warnings alone do not trigger action. They must overcome inertia. In this case, multiple examinations occurred over the years, yet none penetrated the core fabrication because they did not demand third-party trade confirmations or reconcile claimed derivatives exposure against exchange-level volume data. The investigations reviewed documents provided by the firm itself. Self-reported evidence passed procedural review. Regulatory failure often stems not from absence of rules, but from shallow enforcement depth. If oversight processes do not extend beyond surface documentation, sophisticated fabrications can persist indefinitely. Another critical factor was scale perception. The sheer size of the operation created a psychological barrier. Large operations are presumed to be monitored. That presumption reduces urgency to intervene. This is systemic diffusion of responsibility at the governmental level. The broader environment also contributed. During extended bull markets, fraud detection sensitivity declines. Rising asset values create optimism. Capital growth dampens skepticism. Enforcement resources may prioritize emerging crises rather than stable performers. Smooth performance can paradoxically reduce regulatory attention. The warnings about Madoff centered on statistical anomalies. His returns did not exhibit expected correlation patterns with market volatility regimes. They did not show dispersion consistent with options overlay strategies. They remained improbably stable across stress events. Yet, without aggressive subpoena power applied to counterparty records, those statistical red flags remained theoretical. Fraud persisted because verification stopped at the boundary of declared documentation. The structural lesson is not limited to one regulator or one era. Financial systems operate on layered trust. When regulators assume market participants are self-correcting, oversight intensity declines. Effective fraud detection requires independent confirmation from clearinghouses, cross-checking claimed positions against market-wide volume, verification of custodial segregation, direct counterparty reconciliation. Without those mechanisms, regulatory review risks becoming performative. Chapter 6 reframes the collapse not as a single actor's deception, but as a systemic failure of escalation. Warnings were raised, signals were visible, but institutional deference delayed decisive inquiry. Fraud at scale rarely exists in isolation. It coexists with oversight blind spots. When complexity meets authority, and authority meets hesitation, the probability of prolonged deception increases. The split-strike loop survived not only because it convinced investors, but because it exhausted regulators. That exhaustion became structural permission. Chapter 7, Liquidity Stress. The collapse trigger. Ponzi systems do not collapse because they are discovered. They collapse because they run out of cash. For years, the Madoff structure maintained equilibrium through net capital inflow. New money funded redemptions. Redemption stability reinforced confidence. Confidence attracted additional inflow. The loop was fragile, but self-sustaining. As long as aggregate subscriptions exceeded aggregate withdrawals, liquidity pressure remained manageable. No underlying assets were required. Only cash flow balance mattered. The 2008 financial crisis shattered that balance. Market panic triggered redemption acceleration across hedge funds, private vehicles, and alternative strategies. Investors facing losses elsewhere sought liquidity wherever stability appeared. Ironically, the very consistency that attracted capital now motivated withdrawals. When portfolios are under stress, investors redeem from perceived safe havens to cover losses in volatile allocations. The Madoff system experienced simultaneous redemption requests measured in billions. That shift exposed the core structural weakness. There were no real assets to liquidate. In a legitimate split-strike conversion strategy, liquidity management would involve unwinding equity positions and closing option contracts. Transaction friction would exist, but asset value would anchor redemption capacity. In this case, asset statements were fictional. The operational reality was simple. Natio incoming cash had funded prior redemptions. No portfolio existed to generate liquidity. Redemption volume exceeded available inflow. The loop inverted. Ponzi mechanics are mathematically deterministic. Let I equals inflow, R equals redemptions. As long as I is greater than or equal to R, the system survives. When R is greater than I, collapse accelerates. During systemic crises, correlation spikes. Investor behavior converges. Redemption pressure becomes synchronized. This synchronization is lethal to any structure dependent on staggered withdrawals. The collapse was not gradual. It was immediate once liquidity imbalance reached critical mass. Madoff reportedly informed family members in December 2008 that the investment advisory business was a fraud and that losses totaled approximately $50 billion in reported account balances. That figure reflected fabricated statements, not actual capital. Real investor losses were smaller, but still catastrophic. Liquidity contraction exposed the illusion instantly because there was no performance cushion to absorb outflows. This chapter reveals a critical structural truth. Fraud endurance is often a function of favorable market conditions. Bull markets mask redemption fragility. Stable volatility suppresses panic. Positive sentiment delays scrutiny. Crisis environments compress time. Modern financial systems contain numerous vehicles with liquidity mismatch characteristics. Open-ended funds holding illiquid assets. Private credit structures with redemption windows. Interval funds with gating provisions. While not fraudulent, these vehicles share a structural vulnerability. Redemption acceleration under stress. In legitimate systems, asset backing provides partial mitigation. In fraudulent systems, there is no mitigation. The Madoff collapse demonstrates that systemic stress functions as involuntary audit. When volatility rises and capital seeks exit, structures must produce cash. If they cannot, exposure becomes visible. The fraud survived market noise, regulatory warnings, and external skepticism. It did not survive liquidity contraction. The split strike loop depended on perpetual inflow velocity. The crisis reversed that velocity. Liquidity stress was not a side event. It was the trigger mechanism. Understanding this phase is essential because future structural frauds will likely unravel under similar conditions, not through intellectual discovery, but through cash flow imbalance. In capital markets, liquidity is truth. When redemption exceeds reality, illusion ends. Chapter 8. Reverse engineering the split strike loop. At its core, the Madoff operation was not a strategy. It was a cycle. Strip away the options language. Remove the credibility scaffolding. Eliminate the feeder fund network. What remains is a closed liquidity loop engineered to manufacture confidence. The loop operated in 6 stages. Stage 1. Promise stability. The narrative of disciplined hedging framed the strategy as structurally conservative. Investors were not buying alpha. They were buying insulation. Stage 2. Deliver fabricated confirmation. Monthly statements showed steady gains. Losses were minimal. Volatility was absent. The psychological reward system activated. Stage 3. Reinforce confidence. Consistency created emotional attachment. Investors increased allocations. Feeder funds expanded commitments. Reputation compounded. Stage 4. Attract incremental capital. New subscriptions flowed in. Exclusivity signaling intensified demand. Growth itself became validation. Stage 5. Fund redemptions with new capital. Withdrawal requests were paid from incoming subscriptions. No asset liquidation required. Cash recycling sustained the illusion. Stage 6. Repeat. This is the split strike loop stripped to its mechanical core. The genius of the architecture was its moderation. Returns were engineered to remain inside a credibility corridor. Excess performance would have triggered audit. Insufficient performance would have reduced inflow velocity. The corridor was narrow but durable. To reverse engineer the system, consider the underlying equation. Perceived assets equals prior inflows minus redemptions plus fabricated gains. Actual assets equals net inflows minus net redemptions. The divergence between perceived and actual assets widens over time. The system remains stable only if new capital offsets both redemptions and the illusion of compounding. Compounding is the silent accelerant. As statements reflect positive returns, reported balances increase exponentially. Redemption requests eventually reference inflated numbers. That inflates the cash requirement beyond historical inflow rates. This creates structural acceleration toward collapse. The loop also exploited social inertia. As account values rose on paper, investors experienced wealth effects. Perceived gains reduced redemption urgency. Many reinvested distributions rather than withdrawing. Reinvestment reduced immediate liquidity pressure. Another reinforcing mechanism was reputational entrapment. Investors who introduced peers to the strategy became informal ambassadors. If doubts surfaced, they faced reputational risk. Defensiveness replaced skepticism. The loop therefore operated not only on cash flow, but on psychology. Confidence to allocation to reinforcement, to advocacy to expansion. Financial engineering was minimal. Behavioral engineering was sophisticated. What makes this masterclass relevant today is not the specific structure but the invariance of the loop. Consistent reported gains. Limited transparency. Centralized custody. Network-based validation. Dependency on inflow velocity. These invariants are portable. Modern variations may involve algorithmic trading claims, AI-driven arbitrage, private credit smoothing, crypto yield platforms, or structured volatility harvesting. The wrapper changes. The loop logic remains. Reverse engineering the loop provides a detection framework. Ask: where does redemption liquidity originate? Are assets independently verifiable? Does performance dispersion align with market regimes? Is growth driven by exclusivity narrative? If the answers converge toward opacity and inflow dependency, structural risk increases. The Madoff event was not merely a Ponzi scheme. It was a demonstration of how moderate returns, institutional optics, and capital flow dynamics can synchronize into a self-sustaining illusion. The split-strike explanation distracted from the loop. The loop was the engine. Understanding the engine transforms the episode from historical recounting into operational pattern recognition. That is the true masterclass. Chapter 9: Operational Implications for Modern Capital Markets. The Madoff structure is not relevant because it was large. It is relevant because its mechanics remain viable. Financial systems today are more complex, more digitized, and more narrative-driven than in 2008. Complexity increases opacity. Opacity increases the probability of misrepresentation. The operational question is not whether another Madoff exists. The question is where the structural conditions are most favorable for repetition. There are 5 modern exposure zones. First, illiquidity with smooth marks. Private credit funds, interval funds, and direct lending vehicles often report low volatility. Unlike publicly traded securities, these assets are marked based on models or internal valuation committees. Low mark-to-market dispersion does not automatically indicate fraud. But when illiquidity combines with unusually consistent yield and limited transparency into borrower performance, risk concentration increases. Second, strategy, opacity, wrapped in technical language. AI-driven trading systems, quantitative volatility harvesting, structured derivatives overlays, and crypto yield platforms frequently rely on terminology beyond most allocators' expertise. When performance appears stable across regimes, while strategy explanation remains abstract, skepticism must increase proportionally. Third, custody overlap. If an investment manager controls execution, custody, valuation, and reporting, independent verification weakens. True risk mitigation requires third-party asset holding and reconciliation. Structural separation is not cosmetic. It is defensive architecture. Fourth, exclusivity marketing. When access is restricted through invitation-only structures, minimum thresholds, or social networks, exclusivity can substitute for evidence. Scarcity narratives discourage questioning. Investors fear losing access more than they fear undiscovered risk. Fifth, performance corridor engineering. Moderate but consistent returns are statistically seductive, not extreme, not volatile, just steady. The Madoff case demonstrated that abnormal smoothness is a red flag equal in magnitude to abnormal outperformance. In volatile markets, true hedged strategies exhibit dispersion. Protection carries cost. Execution timing varies. Slippage occurs. If volatility regimes change but performance dispersion does not, the strategy deserves forensic review. The regulatory environment has evolved since 2008. Oversight intensity increased. Custodial standards tightened. Audit scrutiny improved. Yet systemic vulnerabilities persist because capital continues to reward stability. Investors prefer predictable income, low drawdowns, minimal headline risk. Fraud structures thrive where demand concentrates. Another modern risk amplifier is leverage embedded in structured products. When risk is layered inside credit tranches or synthetic exposures, volatility suppression may mask tail risk. While not inherently fraudulent, such structures can obscure true downside sensitivity. The operational lesson is not to distrust complexity, it is to audit it. Verification protocols should include direct confirmation with independent custodians, counterparty-level exposure reconciliation, stress testing across volatility regimes, independent replication modeling, auditor capability assessment. Professional allocators must treat smooth performance as a variable to test, not a benefit to celebrate. The Madoff event revealed a deeper systemic vulnerability. Capital markets often equate narrative coherence with structural integrity. If the explanation sounds sophisticated and the returns feel stable, scrutiny decreases. Operationally, that is backward. Complex strategies require higher transparency thresholds. Stable returns require higher statistical validation. Exclusive access requires deeper documentation. The Masterclass is not about identifying criminals. It is about recognizing fragility patterns. When stability outpaces explanation, and explanation outpaces verification, structural risk accumulates. Modern capital markets remain fertile ground for deception because psychological drivers have not changed. Investors still crave insulation from volatility. Managers still compete for differentiation. Intermediaries still monetize access. The split strike loop was one expression of a recurring design. Understanding its implications is not optional for professionals operating inside capital systems. It is defensive literacy. Chapter 10, Strategic Defense, Building Structural Immunity. The final lesson of the Madoff Masterclass is not historical. It is procedural. Fraud prevention is not about detecting lies. It is about designing systems where lies cannot scale. Strategic defense begins with structural separation. No single entity should control asset custody, trade execution, valuation, performance reporting. Independent custodianship is non-negotiable. Assets must sit with a third party whose only function is safekeeping. Confirmations must originate outside the investment manager's internal systems. Second, counterparty verification. If a strategy claims derivatives exposure, confirm it at the counterparty level. Options contracts clear through identifiable channels. Large exposures leave observable footprints. Volume, open interest, and clearing data should align with reported scale. If the market footprint is invisible, the strategy footprint is suspect. Third, volatility consistency testing. Run statistical dispersion analysis across regimes. Compare reported returns against volatility indices and benchmark behavior. A hedged equity strategy should show variable drag in low volatility environments and differential protection in high volatility environments. If regime shifts do not affect dispersion, investigation must intensify. Fourth, auditor competency alignment. The sophistication of the auditor must match the sophistication of the strategy. A multi-billion-dollar derivatives program cannot be meaningfully audited by a small firm lacking derivatives forensic expertise. Audit brand alone is insufficient. Capability must be verified. Fifth, incentive mapping. Trace fee structures Identify conflicts. If intermediaries derive substantial revenue from maintaining allocations, skepticism must increase. Incentives shape diligence intensity. Sixth, liquidity stress modeling. Model redemption scenarios under correlated withdrawal conditions. Ask, if 30% of capital demands exit simultaneously, how is liquidity generated? If the answer depends on new inflows, structural fragility exists. This step alone exposes most Ponzi mechanics. Seventh, governance escalation protocols. Organizations must create formal pathways for internal dissent. Analysts who identify anomalies must have escalation channels insulated from political pressure. Suppressed skepticism compounds systemic risk. Defense is not paranoia, it is architecture. The Madoff collapse exposed a recurring institutional flaw. Systems assume good faith until evidence forces reconsideration. Effective governance assumes vulnerability from inception. The goal is not to eliminate risk, it is to eliminate opacity. Modern capital markets will continue to produce innovation. Innovation produces complexity. Complexity demands verification depth. If structural defenses are proportional to complexity, fraud probability decreases. If complexity outpaces oversight, fragility accumulates. The split strike loop demonstrated how trust, once engineered, can override scrutiny for years. Strategic defense ensures trust must be earned continuously through independent validation. The Masterclass ends with a shift in posture. Do not ask, is this manager credible? Ask, is this structure independently verifiable? Credibility is narrative. Verification is evidence. Capital markets reward evidence over time. Fraud exploits narrative in the short term. Strategic immunity requires choosing the former consistently. Chapter 11. The capital psychology that made it possible. No large-scale financial deception survives on structure alone. It survives because human incentives align with illusion. The Madoff system exploited a fundamental tension inside capital markets. Performance evaluation is social before it is mathematical. Professional allocators do not operate in isolation. They report to boards. They compete against peers. They defend decisions publicly. Reputation risk often outweighs portfolio variance. This creates a psychological hierarchy. Avoid embarrassment. Preserve access. Maintain stability. Maximize return. Fraud structures thrive in that hierarchy. When an investment produces moderate, steady gains, it reduces reputational volatility. No dramatic drawdowns. No extreme underperformance. No uncomfortable board meetings. Consistency becomes career protection. This is why the split strike loop endured among sophisticated investors. It did not promise dominance. It promised insulation from professional scrutiny. Another psychological vector was social clustering. Many investors entered through affinity networks, philanthropic circles, country clubs, shared cultural communities. When capital is deployed through trust-based networks, skepticism carries social cost. Questioning the strategy risks questioning the introducer. That social friction suppresses escalation. There is also the phenomenon of cumulative commitment. As reported balances grew over years, investors felt wealthier. Paper gains altered perception. Even without withdrawals, perceived compounding reinforced belief. The longer the track record, the harder it becomes to admit doubt. Behavioral finance identifies this as commitment bias. Decision-makers justify prior allocations by interpreting new information in ways that preserve the original choice. Fraud structures exploit time. The Madoff operation ran for decades. Longevity became proof. Each additional year without incident strengthened the illusion of legitimacy. Duration substituted for validation. Another critical factor was comparative comfort. During volatile market years, many hedge funds experienced dispersion, drawdowns, or strategy rotation. Madoff's reported returns avoided drama. Investors compared anxiety elsewhere to calm within his statements. Relative emotional stability became persuasive evidence. Capital markets are not purely rational systems. They are competitive emotional systems operating under reputational pressure. The Masterclass insight is this: fraud does not need universal belief. It needs sufficient belief among those controlling capital flows. If feeder fund managers are convinced, inflow persists. If institutional committees are reassured, scrutiny softens. If regulators hesitate, longevity increases. Psychology compounds structure. Modern parallels are visible wherever performance stability aligns with professional incentives. Structured yield products, volatility selling funds, and algorithmic systems promising low drawdowns all attract capital because they reduce emotional friction. Investors crave insulation from uncertainty. Managers market insulation as skill. When insulation is fabricated rather than engineered, systemic risk accumulates quietly. The final psychological vulnerability is prestige bias. When influential investors allocate, others follow. Influence compresses independent analysis. Few want to assume they are more perceptive than the collective. But collective belief does not produce collective verification. The Madoff collapse was not merely a liquidity event. It was a reputational shockwave. Institutions, foundations, and prominent individuals were exposed simultaneously. The embarrassment was systemic. That embarrassment reveals the final lesson. Capital markets reward conformity until conformity fails. The split strike loop survived because it aligned with investor psychology at every level. Moderation over spectacle, exclusivity over accessibility, stability over volatility. Understanding that psychology is defensive armor. Future structural fraud will not advertise itself as extraordinary. It will present as reasonable, disciplined, reliable. The Masterclass concludes here. Fraud at scale is rarely built on greed alone. It is built on the universal desire for calm inside uncertainty. When calm appears too consistent, scrutiny must rise proportionally. That discipline separates durable capital from vulnerable capital.